What's going on, you guys? My name is Zach Hartley, and in this video I'm going to walk you through how to use put options to make money when stocks are going down. Here is everything you need to know. Let's go. Okay, so why use put options? That's probably the first question to ask and answer here, and the answer to that is to make money on the declining prices, like I mentioned before. But the other reason that you might want to use a put option is to hedge your portfolio. What I mean by that is, let's say that you have some stocks in there that you don't want to sell, but you're worried about the downside risk. Well, you can buy a put option because it has a high risk to return ratio, so that if those stocks decline in price, you'll make up a lot of that money on the increase in the value of your put options. And so a lot of hedge fund managers and large investors buy put options as a hedge against the rest of their portfolio and to protect their overall balance. They pay a small fee up front, but if the value of their overall portfolio declines, they make a high return on those options. And so there's a variety of different reasons why you might want to use put options. If you're looking for a way to make money just as stocks are going down, you could also use an inverse ETF, or you could short the stock itself. Put options have a variety of different benefits. Primarily though, people will use them as a strategy to make money in a bearish economy or to hedge against their portfolio. Now, what are put options and how do they kind of work? Well, put options give people the right to sell shares of a stock at a specific price on a specific date. Now that sounds kind of broad and general, and it is broad and general because there's actually a lot of terminology when it comes to dealing with options in general. And so I'm just going to review that for you real quickly here so that you can kind of understand what an options contract looks like. Here is kind of the output that you'll likely see on your brokerage account. And so I'm going to walk you through what all of these different kind of pieces mean right here. So the first piece of terminology that you need to know about is the word contract. Now, a contract represents 100 shares. It's kind of like how a dozen eggs represents 12 eggs. One contract represents 100 shares, and that is what options are bought and sold in. Just like eggs are bought and sold in a dozen, options are bought and sold in contracts that represent 100 shares. And you can only buy contracts in whole numbers, so you can't buy a fraction of a contract or half a contract. It has to be a whole number, like 1 or 2, and that means that the minimum investment to get into any options is going to be one contract that controls 100 shares. And that is exactly what we can see down here. We can see the number 1 right at the beginning here. That represents that whatever security we're going to be dealing with here is going to be 1. And so we have one contract right here of the ticker symbol AAPL. You're probably familiar with this. This is Apple, and this is the ticker symbol. It is the up to 4-digit code that represents a specific stock. Remember, options are based on the price movement of a stock. So when we buy an option, we need to determine which stock we are focused on. Now, the next piece here is the expiration date. This is the date at which your contract will expire, or your options will expire. And so if you are in the money, or if your contracts are doing well, your broker will likely automatically convert your options and either sell them if they are put contracts or buy them if they are call contracts. And so your expiration date is the last day to which you can buy or sell any options for this expiration date. Now, the strike price here is the price at which the broker will execute the transaction. For us, we are buying put options. So in this scenario, it will give us the ability to sell shares at $140. Now, if we are buying a call, it would give us the ability to buy shares at $140. But as you can see here, we have it listed as a put because we want to be selling our shares at $140 with the hope that the market price on June 17th is going to be well below $140 so that we can capture that difference there as a profit. Now, the last piece of terminology you need to know about is the premium, and the premium is what you are going to pay in order to buy this contract here. What happens in options is that we buy the contract up front here with a small little fee that we call the premium, and that fee gives us the ability to buy or sell those shares later on, depending if we are buying or selling call or put options. And so that is the cost of the actual option up front, and then you either need to have the shares in your account if they are a put option, or you need to have the money in your account if it is a call option. Now, here is an example. We can just simplify everything here and walk through a simple example of buying one put contract for $5 per share of Apple stock with a strike price of $140 and a June 17th expiry. And so in this scenario, the premium here is $5 per share. And the minimum number of contracts that we can purchase is 1, which is exactly what we have done here. But because a contract represents 100 shares, that means our total cost here is going to be $500. In this example, we are buying it with a strike price at $140 and an expiration date of June 17th. And so if the price of Apple shares is, let's call it $100 on June 17th, that means that we can go into the market and buy the shares at 100 and we can sell them at $140 and capture that $40 profit inside. So let's go through a scenario here. Let's say that on June 17th, the price is actually $110. That means that we can go into the market and we can buy 100 shares of Apple at $110 per share. And then at the end of the day, when we exercise our contract, we will sell them at $140. That will generate a $30 per share profit. And when we do that for all 100 shares, that will give us a $3,000 profit. Now, do remember though that we did pay $500 upfront for that premium, which gave us the right to sell at $140. So we have to subtract that from our profit here. And that gives us a total of $2,500. And you may have to pay some commissions depending on which brokerage you're using and which country you are from. But overall here, we just turned a $2,500 profit on a $500 investment, which is extremely, extremely impressive and very nice to see. Now, in scenario 2 here, let's say that things didn't quite go our way here and things didn't go very well and the price actually went up and now it is sitting at $150 while our strike price is still at $140. Unfortunately, in this scenario, we have options that are below the market price of the shares, and that makes our options absolutely worthless. And in this scenario, we would lose our full $500. And the reason that we would lose it is because there is no point in exercising that option, because if we did, we would lose even more money. It means that we would have to go into the market and buy 100 shares at $150 and then sell them at $140, and we would lose another $1,000. So nobody wants to do that. It's not a good idea. We would just take our $500 loss right here and we would just call it a bad trade. And so in this scenario, we would lose actually 100% of our investment. So this is where the risk to return ratio is greater. If it goes our way, we make much more than 100%. But if it doesn't go our way, we're much more likely to lose our entire position that we went in with. And so it's definitely something to consider when you get into options. You also need to know that you do not need to hold the premium until the expiration. So when you buy that contract and you pay that $500 up front, if it looks like you're going to make money and the stock is going your way, the value of that contract will increase in value and you will actually be able to sell it in the marketplace if somebody else is willing to buy it. And so there is no requirement that says you need to hold that contract all the way until expiry. If there's enough volume on the stock and the option that you are trading, you'll be able to sell it in the marketplace, usually on a daily basis or a weekly basis if required. Now, in that scenario where you do plan to buy and sell before expiration, you do need to know that volume and liquidity are super, super important. If you're buying for a long ways out or a very far off price that is far from where the stock is currently trading at, you definitely need to watch out for volume and liquidity and make sure that there is actually going to be somebody there that is willing to take that trade on the other side at a reasonable price. Because if there's just nobody that wants to trade that option for that expiry and that strike price, you're going to have a very, very tough time selling it in between. Now, once again, I do need to caution you, options are extremely volatile and they have a much higher risk to reward ratio than just buying or shorting the stock. So definitely keep that in mind here and use them very cautiously. Now, if you're interested in learning how to do this and seeing me make a couple of trades, definitely check out my totally free course. It is called Options Trading for Beginners and it is hosted on Skillshare. You get a 1-month free trial when you use the link down below. There's almost 2,000 students that have gone through the course. There's over 79 reviews on it, and there's over 169,000 minutes of watch time. It's only 2.5 hours long though, and I would love to share it with you. Like I said, it's completely free. When you use the link down below, it'll take you to Skillshare, and then you can decide whether or not you want to stay with Skillshare. I highly recommend it though. And thank you so much for watching to the end of the video. I sincerely appreciate it. Good luck trading, good luck investing. And if you want to learn more about what I'm doing, check out the links in the description down below. And we'll see you in the next one.